Hey, welcome to the Week in Bite presented by the Wall Street Breakfast. I'm Daniel Snyder. Thanks for tuning in. So, the VIX index is still over 30 this week, and there's no wonder why. The perfect storm has been brewing between central bank decisions, hot inflation numbers, and more importantly, the war between Russia and Ukraine. Here to give us a brief update is managing editor at Seeking Alpha, Kim Khan.
Yeah, well, Dan, you mentioned the VIX in the mid 30s of volatility has been the story of the week as we are now getting into a very much a trend of moving on headlines. Right now, investors on the equity side seem mostly focused on ceasefire talks and how those are progressing or not progressing, as the case may be. And kind of every little flash that we see on the terminal comes up and gives the market another reason to trade a certain way. And then you've also got the whole commodity sphere, which is, moving not just to these headlines, but also on fundamentals and speculation. We've got oil prices now that were surging when, going into what looked like U.S. banning imports from Russia, which they eventually did, and then plunging afterwards on people talking about peak sanctions. And then you've got other areas like the nickel market, which went crazy on a short squeeze and up to more than $100,000 a ton, causing the London Metals Exchange to stop trading. And they're thinking about they still haven't reopened it yet as they try and settle on what's going on with price discovery. So a lot of unprecedented moves, and again, as you said, a volatile week.
Yeah, and I think I just saw the report not too long ago here that says the LME, the London Metal Exchange, is reportedly keeping the nickel market closed until at least next week. So we won't even see that here into the end of the week. I mean, who would have thought, right? What a time to be short nickel. All right, Kim, well, we'll see you here in a little bit for the Catalyst Watch, all right? Now, this is exciting. We have a special guest joining us on today's episode, the man behind the math of the quant system here at Seeking Alpha, our very own head of quantitative strategy, Stephen Cress. Steve, thanks for joining us this week. I couldn't think of a better time in the market than now. With everything going on, investors are frankly looking for quality stocks to buy on this dip or in this bear market, to be determined, of course. But you have a new stock idea that the quant system also has a strong buy on. So could you tell our audience what that stock is and why you like it right here?
Absolutely, Daniel. Thanks for having me. Today, I'm focusing on a stock, literally on Semiconductor Corporation, ticker symbol ON, currently trading at $56. ON is an American semiconductor company, and I've actually picked it as a clean energy stock. That might seem quite unusual considering the typical stocks that are solar power or wind power. ON, again, is a semiconductor company. But the reason why I focused on it is they are quite the force in the clean energy field. I recently wrote about it in an article called Two Best Clean Energy Stocks. The stock was also featured by another essay contributor, Robert Castellano, in an article called Ford and ON Semiconductor, Two Picks Bucking the Semiconductor Shortage. ON may seem an unconventional energy stock, but it is a driving, disruptive force with many innovations within the semiconductor world, specifically with their focus on the automotive sector and more specifically on EVs. This is an exciting opportunity above and beyond being a semi provider, which are typically out there for cell phone companies and laptops. Typically, a cell phone has about 4 chips in it. An automobile can have 2,000 to 4,000 chips. They are literally mainframe computers on wheels. There's an amazing opportunity for onsemi in the automotive industry. Organically, investors already knew there's a movement underway for EVs. However, over the last 52 weeks, the energy sector is up 44%. WTI is above $107. Gas prices have reached 2008 levels, and diesel just hit a record high in North America. Auto consumers now find that there's an added urgency to move to electric vehicles. And ON Semiconductor is absolutely crushing it within their sector. The company has great fundamentals and great quant grades. Specifically on the quant side, we do have a strong buy, as you mentioned. I will list the investment characteristics that we focus on and reveal what their grades are. As a reminder, grades are always sector relative. So in terms of ON for growth, They have an A compared to the sector. For profitability, an A minus. Momentum, A plus. And analyst estimate revisions, A plus. On valuation, they get a C plus, which frankly is much better than a lot of other technology companies that are still overvalued, despite the Nasdaq coming off sharply from its highs in early January. So the valuation is still really nice for this stock. As I said, they're absolutely crushing it against the sector, though. When you look at them compared, taking price performance over a 1-year period, the stock is up 54% compared to the sector, which is down 10%. If you looked at it in the last 6 months, On Semiconductor is up 29%. The sector is down 15%. And just over the last 3 months, On has taken a bit on the nose with the rest of the Nasdaq. The stock is down 7.7%, but the sector is down 14%. So as I mentioned, there are a number of investment characteristics where the stock looks really good. Growth being a leading one. Our overall growth rate is A, but some standout underlying metrics within growth. Their revenue growth going forward, we give them a B. The company is growing at a rate of 15% versus 13% for the sector. If we looked at the year-over-year growth, they just had a really good year. Year-over-year revenue growth was at 28% versus 19% for the sector. But when you get to the bottom line, looking forward, EPS diluted is growing at 73% versus the sector at just 18%. And 18% is nothing to sneeze at for growth, but this company is growing at 73% for its bottom line. On is a differentiated chip maker at the top of its game, and it's got a portfolio set to lead with continuing grabbing market share from all the other providers in the semi world. Providing its continued success, On has had another stellar earnings report. In 2021, revenue increased, as I mentioned, 28%, with operating income and free cash flow up 6 times despite the pandemic's supply chain constraints. In terms of profitability, they get an A minus versus the sector. EBIT margins come in at about 20% versus 8.9% for the sector. Net income margins are at about 15% versus 5% for the sector. And levered free cash flow margins are at about 13.3% versus 10% for the sector. So in terms of profitability, it's really leading the sector. On value, it's the one grade that, wasn't in the sort of A, B territory. Overall value, it's a C plus. We look at a lot of valuation metrics, but I got to tell you, on some of the core metrics, it still looks really good. In terms of their PE on a forward-looking basis, we give it a B plus grade. Its PE is 14 times. The sector is at 19 times. So despite having stellar growth, it's still cheaper than the sector on a PE basis. And that's a I think it really stands out. But more importantly to me, if I look at it on a PEG basis, we give it an A plus grade on a PEG basis. It's at 0.38 versus the sector at 1.43. So to me, I love taking value and combining it with growth. So I focus in on that PEG metric, and it looks absolutely outstanding. In terms of professional Wall Street analysts, they love the company in the back of its last quarter. And for their full year estimates, recently 29 analysts revised their earnings estimates up for the company, and no analyst revised down. And that's the last 90 days. Again, 29 analysts taking up estimates, no analysts taking it down in the last 90 days. So I think overall, considering the sense of urgency that's out there with energy prices where they are, and it looks like this could be sustained for a long period of time, I believe that there's going to continue to be a move towards green energy, but specifically, this company has real earnings. It really focuses on the EV market. It helps out more than one automaker in the industry. Obviously, we know that chips were highly constrained over the last year, but this company is out there bucking the trend, and they're in a sweet spot. So that's my choice on Semiconductor. Strong buy from a quant perspective with stellar grades.
Yeah, thanks for that breakdown. I mean, that was very detailed, and I know our audience appreciates it. I do want to take a quick second and actually point out we do have the symbol page pulled up here on the screen I just want to go into the quant section of the ratings and just really just point out that this isn't a new pick from the quant by any means. I mean, if we look back at the history chart here over the last year, even back when the stock was in the 30s, we had a buy on the stock from your quant system.
That's correct.
And here we are today trading around $57, and it's still a strong buy, right? And probably for all those reasons that you just listed out with the metrics and the growth story ahead of us. And Steve, I can't help but think back to the beginning of this year. You had top stocks that you picked for the year as well, which also included some semiconductors.
That's correct.
So, I mean, the semiconductor space overall, are we just going to continue to see growth here? Is that what it kind of looks like?
Well, I think we're going to see growth, especially as the supply constraints dissipate a bit. But really, like what I like about this stock is, their focus in EV. Clearly, there was some momentum in EV already, and that's outside of Tesla and some of the other players that are coming on board. We know people have been buying their vehicles, but really, now that we see like Chevy coming out with their pickup truck and Ford coming out with their pickup truck, I think what's amazing about the Ford electric F-150 is they actually just stopped taking orders for it because there's so much demand. And ON Semiconductor is in that sweet spot in the automotive sector.
I do want to go back and point out, if I can, real quick. Let me see if I can pull this up while I still have you. You did mention the earnings revisions. We pulled that up a second ago, but also when we go into the Wall Street analyst breakdown that we have here on Seeking Alpha, the average price target listed here is still averaging around $73. And of course, you see the breakdown of the analyst, the sell side analyst there, with 16 having strong buys and only one sell, actually. So it looks like there's a lot of agreement across the street that ON Semiconductor is probably a great stock for the months ahead and maybe potentially years. We'll have to see. All right, Steve, I appreciate you joining us today and giving us that stock idea. I know our audience appreciates it. You have a good weekend, okay?
Thanks so much, Daniel. Take care.
Now, let's bring in our headliner for today's episode, Nick Bunker, Head of Research North America at Indeed.com. Nick, you're the man with the data when it comes to employment, unemployment, quit rates, and more. So what are you seeing in this market right now?
The labor market right now in the U.S. is extremely tight and very hot. So if you told me back in April 2020, after we got some of those employment numbers, 20 million people losing their jobs about 6 weeks. If you told me that less than 2 years later, we'd see an unemployment rate below 4%, vacancies near all-time highs, and sort of job switching rates at levels we haven't seen since the late 90s, I would have been shocked. But that's where we are. And with the high level of demand for workers and some signs that folks are returning to the labor force at quicker rates, there's some potential for much stronger growth in employment. And the possibility that at some point, potentially this summer, we're back to pre-pandemic levels on some key metrics of the labor market. So I think there's lots of possibilities. We have to hope that economic growth can keep chugging and get us there.
Now, what key metrics are you referring to exactly?
So I think there's two. One is just the level of payrolls. So that if you look at, from the jobs reports, if we keep growing at the rate we've seen over the past 3 months on average, we'd sort of recoup all the losses that we've seen since February 2020 by this summer, so June or July, which would be an incredibly quick recovery, especially compared to what we saw after the global financial crisis. And similarly, another metric I'm keeping an eye on is the employment to population ratio for people in their prime working years. That's ages 25 to 54. And similarly, if that keeps growing at the rate we've seen over the past 3 months, we'll get back to pre-pandemic levels in about June or July. So if on those metrics, if we keep chugging along at the quick rate we've been going at recently, this summer could be a nice benchmark and get back to where we were before the pandemic.
Nick, I want to ask you, though, because I think this is something that's come up in a few of my conversations as well, is, when the pandemic hit, it's almost like people got early retirement, right? And we saw people, whether that's, a significant portion of the female demographic as well, leaving the workforce. So if you're saying we're almost back to pre-pandemic levels, does that mean that the people that we thought were retiring early or calling their retirement finally, or the female demographic, are they all coming back into the workforce, or is this someone else filling those roles?
So I think while in aggregate it's been a really robust recovery, there are some groups that are lagging a little bit. I think when it comes to like the gender breakdown, I think a lot of those disparities, for women's employment versus men's, some of those have faded, particularly as some of the industries that got really hit hard by the pandemic have come back. They tend to disproportionately employ women, so that could be responsible for that. Also, one factor that was leading to women's employment rates tend to lagging men's was a lot of the childcare constraints. Just the shift from in-person schooling to remote learning did have a significant impact on labor force participation and employment rates for women, but that constraint seems to be easing, and those mothers are sort of returning to employment. But then, you mentioned older folks and retirements. So part of that trend is just that even absent the pandemic, baby boomers were getting older and heading into retirement age, and obviously they're a large portion of the population. So there are folks who have retired over the past 2 years who aren't coming back to labor force, and for good reason. They're taking a well-deserved retirement. But there are some folks who had, maybe got pushed out of a job or were hesitant to return to one and said, I'm retired. But now, as we're in a period where the pandemic seems to be waning, there's a tight labor market, they are actually returning to the workforce. So there's some potential for that older group, their employment rates and participation rates to rise, but they're not going to be sort of the same share of the labor force or contributing as much to employment as they were in the past, just because they continue to age.
Yeah, I want to take a moment though and kind of switch gears a little bit. Last week we spoke with Eric Basmachian. He's a Seeking Alpha marketplace author with EPB Macro Research, and he kind of gave us the full breakdown of real income growth slowing down. And I think that's a big factor as well within employment right now, right? We're seeing the high quit rate, or people quitting their jobs to move to a new job, potentially to get a bigger salary just so that they can try to keep up with life with the hot inflation going on. I'm just kind of wondering, what are you seeing from your side in regards to this shift that's happening of people jumping from job to job, trying to, I wouldn't say take advantage of the opportunity, but maybe instead just try to keep up with the cost of their lifestyle?
Yes. So sort of my read of the ultimate source of why people have been switching their jobs or quitting their jobs such these high rates is that there's just more opportunities out there. It's perhaps not that surprising that we're seeing we've hit new highs when it comes to Cress rate. At a time, we've also been hitting new highs when it comes to the number of job openings, a really good an indicator of sort of labor demand. And if you were to just use, say, very simply use job openings to sort of predict what you would have thought the quits rate would be, using pre-pandemic trends, you get pretty close to the rates we've seen over the past few months. So I do think that it's really sort of a pull factor there, that people see opportunities and they are quitting their old job to take a new job and getting raises that way. Now, obviously, we saw those CPI numbers that came out this morning. Inflation is very high and higher than even some of the gains that people are getting from switching their job, which are quite high right now. So I think it is, this job switching is sort of in spite of the inflation, rather than sort of being driven by it.
So what do you anticipate coming down the line? I mean, as you mentioned, the inflation, I think it's the hottest in 40 years, I think is what we heard come across the wire. And obviously you mentioned the job openings as well, which we're still well over 10 million job openings, right? So if we're getting back to a close level of full employment in regards to the population, where do we go from here?
Yeah, so I think outside, assuming no sort of outside shock to the system or the labor market, it does look like the labor market's going to continue to be very tight, and that's going to lead to workers still having some advantageous bargaining positions, and we'll continue to see quite strong wage growth. I think the question is, how much of the inflation feeds through to people's expectations when they're bargaining for wages, and that could not only pick up wages, but inflation, and contribute to it. But also the fact that the strong wage growth means that there's some continued strength when it comes to income growth and consumption growth, and that could also push up inflation as well. So I think the question here is, are we going to have wage growth stay at the levels we've seen before, perhaps slow down a little bit, and then correspondingly, is like inflation going to, will it slow down? And if it does, it's going to slow down more than inflation, because while we are seeing, at least on nominal terms, pretty strong gains for people, a lot of those raises are getting eaten up by the high levels of inflation.
Right. So technically, are we stuck in a vicious circle? Is that the easy way to put it? With where job openings are, with as much money as in the system right now, with people fighting for higher wages to continue to buy groceries and gasoline at higher and higher prices, especially this week, right? With barrels shooting up like it did on the reports of U.S. banning Russian oil because of the Russia-Ukraine war. I mean, is this actually going to slow down, or is this a vicious circle of where people are going to have to potentially jump from job to job just to get wage increases to try to, maintain their level of living?
So there's the possibility that job openings do trend down, and for a positive reason. You can imagine the hiring rate does pick up and a lot of those open positions get filled. And there was, some indications that we are seeing more folks return to the labor force and pick up their job search. In the February numbers, we did see, that it does look like the labor force participation for some key demographic groups is picking up, suggesting that maybe employers are going to have an easier time filling some of those positions. And what we also saw from some of those February data is that some of the sectors that have had the hardest time filling positions have seen some of the highest quits rates. Wage growth is slowing there. Now, mind you, it's slowing from summer of last year when there were very, very fast paces of growth. And now it's sort of trending downward towards, for leisure and hospitality workers, like frontline production workers, the rate's closer to 6%, which is much lower than it was in the summer, but that's still, all things, fairly high. So I think there's potential for some easing of these hiring constraints. Some of the bidding up of wage growth could slow down, where it's more sustainable, but quite high.
Yeah, I want to take a second real quick, though. You sent over this chart. I want to make sure that we squeeze this in here. I just kind of wonder, we're talking about the wage increases and we're talking about, the overall employment and everything, but kind of walk us through what we're looking at right here. And does this lead us to, does this help kind of guide us in any ways of what to expect going forward?
Yeah, so I think the quits rate, which is, I think, a pretty good proxy for both employees or workers' confidence and also the rate at which people are switching their jobs, does a pretty good job. It's like potentially signaling what's happening with wage growth. And what you see here is that for both all non-farm establishments, but also then just the private sector, that 2021 saw a very substantial pickup in this rate. And hitting levels we had not seen before in the history of the series. So if you go back to the end of the year 2000, these are sort of a lot of the numbers we saw in 2021 were all-time highs. So that has been part of the story of the very strong nominal wage growth we saw last year. What you can see is that there does seem like there's potentially a flatlining there at sort of the end of this year, beginning of this year. These data can be volatile, so it's hard to know how much of a trend this is, but this is also only through January. And we did see wage growth in many sort of sectors temper a little bit in February. So there's potential maybe this has leveled off a bit. Now, if it levels off, this would be at rates, again, we hadn't seen before the pandemic. So maybe sort of wage growth won't continue to accelerate. It might settle out, but that would be still at a quite high level and levels we hadn't really seen in a couple decades before the pandemic.
Yeah. One last question for you before we let you go. You mentioned specific industries that are kind of lagging. I was wondering if you might be able to share any insight into what those are.
Yeah. So in terms of employment rates, sort of like employment levels, I think the clear industry that's lagging is leisure and hospitality. So that's hotels, bars, restaurants, travel. These are sectors that got hit very hard by the pandemic, and then the sort of efforts to constrain the virus. And while we have seen, in 2020, 21, and particularly so this year, employment gains in those sectors, employment is still very depressed there. So that is one thing to keep an eye on. How much can this recovery continue at these high speeds if those jobs in those sectors are replaced, or if it's going to be a shift in the composition of employment, as a lot of those jobs in that sector that were there during before the pandemic and the demand for them has shifted away, and there's new business models, and that sector might be just a less of a source of employment than it has been in the past.
Amazing. Thank you so much for your insights, Nick. Really appreciate it. You have a great weekend. Okay.
Thanks for having me.
That is Nick Bunker, head of research for North America at Indy.com. Now let's go ahead and bring in Kim Kahn for this week's Catalyst Watch.
So looking at our list of catalysts for next week, Dan, and you get to Wednesday and then bam, it hits you, FOMC decision. And it's really hard to think of a more significant Fed meeting and Fed announcement in recent memory. It's right now for the numbers, like we're going in and the betting is shifted. Now the market has a quarter-point hike, pretty much almost completely priced in, with about a 6% chance of no move. But that's changed dramatically from the 50 basis point hike that was the majority opinion for a while before the conflict with Russia and Ukraine started. We've also got the summary of economic projections, or the dot plot, a new one coming out from the FOMC. Well, and so it's going to be a kind of monumental market day of how the Fed reacts to this, because everyone's still expecting rates to rise and the rate hiking cycle to start, but it's doing so in a time when there's a global conflict that can be a huge exogenous shock to the global economy. And but also at the same time, you've got inflation being stoked by more commodity prices, as you mentioned. And also notice, as we talked about volatility earlier, and our friends at DataTrek have pointed this out recently, that the Fed has never started a rate hike cycle when the VIX was this high, this many standard deviations away from its norm. So it is completely unprecedented in a lot of ways, and it's going to be a really tough line for Powell to walk one way or another to please the market.
Thanks for that, Ken. Yeah, all eyes are on the FOMC, right? Powell, it's lined up. It's like, what do you even care about next week besides that? Don't really sure. Now, Kim, I know you kind of are on top of everything here, right? You're managing editor, so you see a lot of what's going on within regards to what, lack of a better word, the smart money is doing. I'm wondering, do you have any insight into how they're preparing for this FOMC meeting?
Well, I mean, I think I see, right now, if you look at where the smart money is going, they're moving away from, as today's actions say, still moving away from the bigger high valuation tech stocks and the mega cap stocks. Those are, the NASDAQ keeps falling further. And, those are the stocks that tend to get hit the most when, rates rise. And, I think that, if you talk about the bond market being the smart money, the bond market now is we've got the 10-year yield up to 2% today. So that's signaling that, 5, maybe 6 rate hikes this year, you're still priced in. That's where the money is going. I think that there's a substantial portion of people, though, who are going to, hedge against that because they aren't comfortable with what's going on in Russia and Ukraine, and what the next headline could be, and what next move Putin could do that could change the entire dynamic. So we'll see a certain amount of moves up and down going in towards the Fed decision.
Yeah, it's interesting you bring up the bond market too, because I know a lot of the people that I know in the bond side of investing are all keeping their eyes on the 5 and 30-year spread, the 2 10-year spread. I mean, the yields are flattening, right? Which obviously, as we were talking about with Eric Basmation last week, that's kind of a signal, right? It's typically a signal that a recession might be coming down the line. So we'll have to see what happens. But appreciate that, Ken. Thanks for the insight, and we'll see you again next week, okay?
Great. Thanks, Dan.
Well, everyone, that wraps it up for us here on the Weekend Bite. Everyone stay safe and have a great weekend.